Well, welcome to the Aging Boomers. I'm your host, Frank Sampson. Of course, on our show, we discuss so many of the issues facing boomers, their parents, and, of course, an aging population. I want to thank everybody so much for all their support and sharing our podcasts with so many of your friends and family members, and our list keeps growing each and every day. Many of you listen to the show, of course, right on your phones, either on our free app, which you can get, agingboomers.com, or on iTunes, iHeartRadio, or you could go directly to our website at theagingboomers.com. So I want to remind everybody also, today's show is sponsored by Senior Care Authority. A senior placement and elder care consulting organization has a national network of professionally trained and experienced local advisors to assist families. They'll work with you in determining the right path for you or your loved one and discuss various long-term care options, whether it's in-home care, assisted living, memory care, or even possibly nursing. So if you just need an advocate, just somebody to get some advice, you can contact a Senior Care Authority advisor right in your area. You could get a free 30-minute consultation with an advisor by contacting Senior Care Authority at 888-809-1231, or you could go directly to the website at www.seniorcareauthority.com. So we've got a subject matter today. I always say we got a great guest, and we have a great guest. All right? And we always have great subject matters. But this is a subject matter that I personally feel is just so important. Things going on, and you know, one of the greatest challenges we have in our industry is, you know, people being able to afford long-term care. All right, and we're going to talk about that today with Christopher Sarantopulos. Chris has been in the insurance industry since 2004 and well-versed in all the lines of insurance: auto, home, commercial lines, employee benefits, life and disability. In recent years, Chris has been specializing in what's called life and disability insurance, offering life insurance with chronic, critical, and terminal illness riders. So, Chris, welcome to the Aging Boomers. Thanks so much for joining us.
Thank you for having me.
Yeah. So, as I said, this is being in the industry, this is something we deal with each and every day. And, you know, I bring up long-term care to people, long-term care insurance to people all the time. And many times I hear, oh, God, you know, that's just so expensive and all of that. And I go, you don't know what expensive is until you have to go into some assisted living, memory care, or nursing home. That's expensive. But I want you to comment on, you know, long-term care and life insurance. Previously, they've been sold separately. Now, and I say this is very recent, there's policies out there that, in a sense, and I hope I'm explaining this right, in a sense combine life and long-term care policies. I've heard it called accelerated benefits or living benefits, so hopefully I'm not butchering that term. So, Chris, you're the expert. Tell me more, tell us more. How does it work?
So recently, I'd say within the past 2 to 4 years, life insurance companies have come into the industry and offered exactly what you said, is life insurance policy with accelerated benefits. I've also heard them be called hybrid policies. And what these policies are designed to do is allow the insured or the consumer to access the death benefit while alive for 3 particular instances. And those instances are chronic illness, critical illness, and terminal illness. A chronic illness is deemed to be prevalent if you cannot do 2 of the 6 activities of daily living. An activity of daily living is bathing, dressing, toileting, transferring continence, and eating. If you are unable to perform 2 of those, you can access the death benefit for nursing care or hospice care and pay for those services out of the policy. a critical illness is a major heart attack, a coronary artery bypass, a stroke, blood cancer, renal failure, things of that nature. If you have one of those conditions, then you can access the death benefit. Terminal illness is if you are deemed to pass away in the next 24 months because of cancer or for whatever reason, you can access the death benefit. And let's say, for instance, you have a $500,000 policy and you pull out 50 to 60, maybe even $150,000 out of the policy to pay for the medical expenses, pay for the hospice care, pay for the nursing care. Then you pay for the care out of the policy, and then your beneficiaries get the difference of the policy. They're called accelerated benefits, and this is how many people are going about paying for their long-term care.
So let's take a step back. You had mentioned that this type of a program could cover nursing, hospice. All right. What about other types of long-term care? I know, getting a caregiver to take care of someone at home, even if let's assume they need assistance with a minimum of those 2 ADLs, as you mentioned, activities of daily living, or they need to go into a licensed assisted living or memory care location that's not deemed hospice, it's not deemed nursing. So does this most long-term care insurance historically has covered that? Do these types of policy cover that type of care as well?
Absolutely.
Okay.
Any kind of expenses that are accrued because of the chronic, critical, or terminal illness it can be paid for out of the policy. So there's no restrictions, so to speak, on in-home care versus hospice care versus a memory facility. All of this can be paid for out of the policy.
Okay. So just so I'm clear, so the benefits may be provided in the policies themselves, but they also may be added by riders or attachments to new or existing policies. Is that right?
No. They cannot be added to an existing policy.
They cannot. Okay.
They cannot be. Any new policy can be issued with these three riders, the chronic, critical, and terminal illness. But if somebody out there has a life insurance policy and they would like to add these benefits into their existing policy, that would not be allowed. The insurance company will not do that.
Okay. So I'm just, what I'm trying to understand also is, somebody to get life insurance, they have to be approved. Okay. Somebody to get
Correct.
long-term care insurance, they also have to be approved. Okay.
Correct.
Is the approval process for this type of a policy where you're having both, is it as stringent as long-term care, or, is it somebody, for example, who is, let's just say, in their 50s right now, okay? And their health is pretty good. They've had some issues, this and that. They might get approved for life insurance, but they could get not approved for long-term care. I've seen that happen depending upon what's going on with them. But would you say the approval process is more strict compared to the past, or is it about the same?
No, I would think that it's just about the same. I have not had anybody apply for this policy and had the accelerated death benefits decline from that portion of the policy. So what I mean by that is, if you apply for the life insurance policy and there's a chronic illness rider built into the policy, if you get approved for the life insurance policy, the chronic illness rider will be approved as well. There is the underwriting process, I would say, is just about the same. There's an application, then there's some field underwriting where you would have to take a blood and urine test and answer some medical questions. If you have some pre-existing conditions, the insurance company will probably reach out to your physician to ask some questions and get some clarification on those pre-existing conditions. And then at that point, a formal offer will be offered by the life insurance company, and then we put the policy in place. But as far as the underwriting being more strict or less strict, I would not say that. I would say it's just about the same.
So what kinds of policies have these types of benefits? I mean, are we talking term, whole life, universal life? I mean, or is it a whole different type of policy than what we're used to?
They're exactly the same. You can buy these policies in a term fashion where it would be a 10, 15, or 20-year term. You can also buy these policies in a permanent fashion where it would be a universal life policy or a whole life policy. But what everybody is used to, the term or permanent or the universal life or the whole life, they're the same type of policy. This is just an added living benefit built into the policy. It's not a different name. It's a term policy with accelerated benefits. It's a universal life policy with accelerated benefits, or it's a whole life policy with accelerated benefits. But the verbiage that people are used to it stays the same. We're just going to add the living benefit portion to the end of it.
So, we see that on regular network television, cable television. I mean, there's advertisements galore for, all sorts of prescriptions and drugs. Obviously, they're reaching out to the, elderly population or that boomer population. And you see ads and all the time to get life insurance. Pay so many cents a day and get this policy. So, that they're usually talking about term there. And so, number one, why don't you explain just generally what a term policy is, and then I'd like to do a follow-up question to you on term, just to make sure people understand.
So a term policy is going to be active for a specific term, whether that term be 5 years, 10 years, 18 years, 20 years, 30 years. That's how long the policy is going to be active. The beauty of the policy is that they're fixed rates for a specified term. The rate does not go up. It does not go down. As long as the premiums are paid, the policy is active for that predefined term.
Okay. And usually the premium, if somebody wanted to continue, I mean, the premiums could go up pretty significantly, right? After they get a certain age.
At the end of the term, the premiums are fixed for that term of 20 years, let's say.
Okay.
At the end of 20 years, you will have the opportunity to renew that policy at a much higher rate. Usually that premium is defined in the policy booklet that is delivered at policy issue. So coming up to the term, coming up to the end of the term, the insured will know exactly what that premium will be for the 21st year. But the premiums are set up in a way where it would be extremely expensive. I've never had a client at the end of the 20-year term or 15-year term policy want to renew that policy at that particular premium. Let's say the premium was $100 a month for the 20-year term. That 21st year, the premium would skyrocket to something ridiculous, like $1,000 a month.
Right.
So you'd forfeit the policy and there would be no
Okay.
insurance.
You did a great job in explaining that. Now I'm going to do my follow-up question with you. Let's bring up this scenario. Sure. All right. I buy a 20-year term policy. Okay. Including the living benefits, what we've been talking about. So it's that combination policy, right? 15 years into the term, I've been diagnosed with some form of dementia, all right? And now I'm going to have to start getting some care, whether it's care at home or whether I have to go into some sort of assisted living or memory care. And my illness continues on for another 6, 7+ years beyond that policy, that now that term has ended, is the benefits continue or is the benefits stop?
Well, the benefits are predefined. There's different severities of the condition. So let's say if you got a case of cancer and you needed to pay for some of the healthcare, there would be a predefined amount that would be given to you from the life insurance policy.
I see.
At the time of your condition.
Gotcha. So in the example you gave before, regardless of the illness, you have a $500,000 policy, you need care, they allocate $50,000. When that $50,000 is done, it's done.
Correct.
Got it. So how do these insurance companies, because this is a lot what we deal with people, with dementia, Parkinson's, stroke, things like that. How do they determine how much they're going to allocate? Is that predetermined in the policy itself, or with that type of diagnosis?
No, it's not predetermined. It's a conversation in between the insurance company and the physician. Obviously, there's different levels of cancer. There's stage 1, stage 2, stage 3, stage 4, and that is going to determine the amount of benefit that you are going to collect.
Okay, so it's the same thing with dementia, same thing. Because obviously doctors don't know how long somebody will live for. Nobody
Correct.
knows. So so it's possible that the amount that's allocated could cover that person for the rest of their life. All right, and it's possible that it could end before their life ends. Correct?
Yeah, you're 100% correct. The life expectancy of people it's getting longer and longer, so there is a possibility that you can outlive the benefit.
Gotcha. Oh, okay. That's good. Well, I mean, it's the same thing with long-term care insurance. It's capped. At least the newer ones are. Some of the older ones are unlimited, but you don't see that anymore. Yeah.
That is true. The main difference in between the two policies is that long-term care, you may use it or you may not. The life insurance with living benefits, you may use or you may not for these particular instances. But with the life insurance policy, at least your beneficiaries are going to get the benefit of the policy itself. Whereas the long-term care policy, if you don't use the benefit, your next of kin aren't going to get anything.
Mm-hmm. Right. Follow. So what do you say to somebody, and I've heard this, I'm sure you've heard it many more times than I have, but what do you say to somebody who says long-term care insurance, wow, that's just too expensive? Again, now you've got this new type of a policy. All right, so how do you respond to somebody who makes that type of statement? Let's just say, again, somebody in their 50s, pretty good health. What do you say to somebody like that?
Well, I acknowledge the problem. The problem with the long-term care policies in recent years is that they have been going through extreme rate increases. With the life insurance policy, when I illustrate the policy, I explain to them in a very detailed fashion that these premiums are going to be fixed for the life of the policy. And then we discuss on the actual cost of the care if needed. Some of these long-term care facilities or hospice cares can run up to $7,000, $8,000, $9,000 a month. And when you break the cost of the care versus the cost of the policy, the cost of the care is much more expensive than the cost of the policy. And knowing that these premiums are going to be fixed for the life of the policy, it settles some nerves, so to speak, because these clients of mine that are 50 or 55 years old that are looking to retire in 10, 15, maybe even 20 years, they know that when they get to a certain age that the premium is still going to be the same amount. Where the long-term care policy, on the other hand, many of these many of the insureds nowadays are getting rate increase letters on an annual basis, and they can no longer afford the premiums because they went from one premium. Sometimes they're doubling, sometimes they're going up in 25, 30%. But the life insurance policy, on the other hand, it's going to be fixed for the life of the policy.
Gotcha. So, yeah, I mean, the one thing we do know, and this is fact, we're all going to die, right? But we're all not going to need long-term care. Though statistics show once you hit 70, you got a pretty good shot that you're going to need some sort of long-term care, you know?
Yeah.
So, great. So in the example that you gave, $500,000 policy, they need long-term care. They take $50,000 just as an example and use that towards long-term care. Is that pretty typical of what you've seen, or is there a limit on how much of the face value of the policy can, in a sense, be paid out early for long-term care?
No. The $50,000 it's an arbitrary figure. If $100,000 is needed or $150,000 is needed, the money is there to be used for medical expenses, hospice care, whatever it may be. The severe cases can up to 85 or 90% of the policy can be advanced to somebody while they're still alive.
That's I think it's a wonderful thing. It really is. So
it really can be.
Yeah.
Well, the thing is what people need to realize is that the money pulled out of the policy can be spent for whatever expenses accrue due to one of these conditions. In addition to that, the money that they're pulling out of the policy is tax-free. Per the IRS code, somebody can pull up to $340 a day out of the policy and not be taxed on that money. So it would be much better to pull money out of a life insurance policy to pay for hospice care as opposed to liquidating assets.
Mm-hmm. Right. So what are some of the? Well, I'm sorry, I got a couple questions in mind. I didn't know which one to ask first, so I'm going to ask this one. All right, and if you can't answer it, I totally understand. I'm just trying to get a feel for it. So, in your experience, whatever a term policy would normally cost somebody, okay, whatever that is, all right. Mm-hmm. Again, before these, is it referred to as a living benefit or accelerated benefits? What's the actual policy? This new type of policy called?
Both. An accelerated benefit, yeah, it is.
Okay.
Each term means the same exact thing.
Okay, so before accelerated benefits started, somebody would pay X amount of dollars premium for, let's say, a 20-year term policy, okay? Whatever that is, all right? What have you found percentage-wise, and you could even give me a range, by incorporating an accelerated benefit program, what percentage have those premiums increased by? Is that?
I'd say about 20. I'd say right about 20 or 25%.
Wow, that's. I mean, my reaction to that is that's cheap.
It's not. Well, I'm sorry.
When I say cheap, I mean it's very. When I say cheap, I'm talking in a positive way. It's very reasonable.
I agree 100%. When I present a policy with living benefits, I will also present a policy without living benefits. And in the past 12 to 18 months, I haven't had one client accept the policy without living benefits over the policy with living benefits because of price. It just does not happen. If you're going to spend $100 a month on a policy without living benefits, to spend $120 on a policy with living benefits is an easy decision.
Got it. So let me ask this one. Let's say somebody had life insurance. They got approved for life insurance. For some reason, in the past, they got denied for long-term care insurance, due to whatever issues they had going on. Would you say that they're probably not going to get approved for this either, or is there a better chance they could get approved with this new living benefit policy?
I don't know how to answer that in a blanket statement. I would definitely dive into the reason why they got declined. If they were declined for long-term care because they were treated for cancer 10 years ago, well, then I would say there's probably a chance that you could get approved because the treatment for cancer is far enough in your rearview mirror that the life insurance company is going to entertain issuing the policy. If they were declined because they were treated for cancer within the past 18 months, they would probably get declined for the life insurance policy as well. But knowing that each life insurance company is going to look at each person on a case-by-case basis, I would have to dive into the reasons why they were declined for the long-term care in the first place.
Okay. So we only have another minute or two here. This is very, very informative. So I'm going to ask you a two-part question here. Just what suggestions do you have to our listeners, things that they should be aware of when considering such a, policy, a living benefit policy? Just any suggestions you have to those that are looking, and then follow it up with how people can reach you. Your website, your phone number, whatever it is you'd like to share, how people could reach you to learn more.
Sure. Step one, I would encourage everybody with a policy to contact their broker or agent and entertain the idea of a new policy with living benefits. These policies are structured to benefit while you're alive as well as when you pass on. The problem with the policies, as with every life or long-term care policies, is they get more expensive as we move on. So if there is a thought that you may want this particular policy, reach out right away, because the policy is as inexpensive it's going to be just because of age. As far as reaching me, our 800 number is 888-701-7015, and our website is livingbenefitsguide.com. That's livingbenefitsguide.com, and I would be happy to answer any questions that your podcast listeners have, as well as issue illustrations so somebody can get a good idea of how much these policies cost.
Chris Sarantopulos, just a wealth of information. I hope our listeners will look into this. This is just, I think, with what we all call the silver tsunami above us approaching, you should be looking at all these types of policies to help with the possibility, not only life insurance, of course, but the long-term care side of it. So, Chris, thank you so much for joining us on the Aging Boomers. I really appreciate it.
Thank you much. Thank you for having me.
Yeah, and I want to thank everybody out there for joining us as well on the Aging Boomers. Just be safe out there, and we'll talk to you all soon.